Real estate is on fire, surging 1.14% this week, with a bullish trend. Now every serious investor needs to know the catalyst driving this rally: interest rates. This is what every serious investor needs to know about real estate right now. Stay with me. Welcome back, or welcome if you are new to Financial Market Oracle. This week, we find ourselves in a market environment characterized by normal conditions, with the VIX index at 19.6, indicating a relatively calm atmosphere. As we look at the various sectors, real estate is one that stands out, given its recent performance relative to the S&P 500. The sector's ETF, VNQ, has posted a gain of 1.14%, which is notable considering the broader market's dynamics. This sector deserves attention right now, as it has been navigating a complex landscape of interest rates, economic growth, and demographic trends. The interplay between these factors has created a fascinating narrative, with potential implications for investors. As we delve into the world of real estate, it is essential to remember that this is educational content and not financial advice. With the sector's prospects and challenges in mind, let us start with the technical picture and what the charts are telling us. The real estate sector, as represented by the VNQ ETF, is showing a bullish signal, with a weekly change of plus 1.14% and a monthly change of minus 0.31%. The RSI reading of 49 implies that the sector is not overbought or oversold, but rather, it is transitioning into a momentum-driven phase. This reading suggests that the sector has the potential to build on its current gains, as it has not yet reached a level of exhaustion. The trend direction is up, with a growing level of conviction, as the sector is attempting to break out from its recent consolidation phase. Key support levels are likely to exist at the lower end of the recent range, while resistance levels are expected to be found at the upper end of the range. The current move does not appear to be an overreach, but rather a sustainable breakout, as the sector is gaining momentum. A specific technical setup worth watching this week is the ability of the sector to hold above its recent lows, which would confirm the bullish signal. Now let us look at the fundamental catalysts driving this sector. The real estate sector is poised to navigate the week of June 8 to June 12, 2026, with a mix of macro tailwinds and headwinds, as the market operates under normal conditions, with the VIX at 19.6. The upcoming CPI inflation report and FOMC rate decision will be crucial in shaping the sector's trajectory. Key stocks such as PLD, AMT, EQIX, SPG, and PSA are signaling a relatively stable sector health, with some pockets of strength in the data center and industrial subsectors. This week, we will be closely watching for any earnings reports from these players, which could provide valuable insights into the sector's fundamentals. From a regulatory perspective, there are no major news items on the horizon that could significantly impact the sector. The longer-term fundamental thesis for the real estate sector remains intact, driven by the ongoing demand for logistics and data storage facilities. This sector is also closely tied to the overall economic growth, and with the current normal market conditions, it is likely to continue its upward trend. Please keep in mind that this is educational content and not financial advice. It is essential to do your own research before making any investment decisions. Next, let us talk about the specific risks you need to manage this week. The real estate sector is navigating a complex landscape, with several key risks on the horizon. This week, investors are primarily concerned about rising interest rates, which could compress cap rates and negatively impact property valuations, a trend that has been exacerbated by recent economic data releases, as well as potential oversupply in certain markets, which may lead to downward pressure on rental yields, and regulatory changes, which could alter the operating environment for real estate investment trusts. Given the current volatility environment, with the VIX at 19.6, position sizing is critical, and investors should be cautious not to overexpose themselves to any one particular asset or subsector. Unexpected headwinds, such as a sudden shift in monetary policy or a geopolitical event, could further exacerbate these risks, highlighting the importance of a disciplined framework for managing downside exposure. And now for the strategic outlook: where does real estate stand heading into next week? This week we maintain a cautious stance on real estate, given rising interest rates and potential market volatility, with sector growth slowing to around 1.5%. A key theme to track is the impact of monetary policy on property prices. Remember, this is educational content and not financial advice. For more insights, like and subscribe to Financial Market Oracle, and comment your real estate watch list below. Until next week, stay informed, stay disciplined, and stay profitable. Cheers! This video is for educational and entertainment purposes only and does not constitute financial advice. Always do your own research before making any investment decisions. Past performance is not indicative of future results.